In this video, I'm going to talk about the three strongest stocks in the quantum ETF, QTUM. That would be Rigetti. That is 216% above its 30-week moving average. That's what we'll be using, the 30-week. D-Wave is 160% above its 30-week moving average, and Ionq is 87% above its 30-week moving average. We'll be looking at things like revenue. We'll be projecting out the revenue for the next 5 years using analyst projections and then adding some of our own projections, trying to get a forward price of sales 5 years from now, which is very hard to do, but we have to do what we have to do to see what a fair value for these companies is, and also see which companies are the cheapest and the most expensive based on that. Then we will also take an earnings model when we get to 2029. We will try to factor in positive earnings, because we need positive earnings if we're going to use the earnings models in 2029, and look forward out 10 years and bring them back to today and see what growth rates and what earnings we would need for these to be fair value if today was 2029 and those prices. At the very end, we'll go through some technical analysis to see if institutions are just dumping these or if they are there's still hope that they are going to come back in. If that's something that sounds interesting to you, stick around and we'll go through that. So the three strongest stocks in the QTUM ETF are Rigetti, QBTS, which is D-Wave, and Ionq. That's using the 30-week moving average. We're ranking them, and they're the highest above the 30-week moving average of any other stock in that ETF. We did sell off this week on these due to Jensen Huang coming out and saying that quantum computing was 15 to 30 years away. But these stocks, even with getting sold off, they have gone up quite a bit, and now just recently been sold off, are still the top three stocks above their 30-week moving average. I track about 60 to 70 ETFs, and if you look here, it ranks number 3 above its 30-week moving average, the Quantum Defiance ETF that these three stocks are held in. Out of all the ETFs I track. So what we're going to do is go through a revenue model, an earnings model, and then we'll look at technical analysis to determine if they are being taken out or if there's a possibility of them coming back. So see if institutions are just getting out and not coming back, or if there's a possibility that there's some support at some point and there could be a rebound. We'll start with the revenue model. So I'm going to click on that tab first. Now, before we get into that, I have the market cap, which comes from Google Finance. I have some data right here from MarketWatch. So all this data right here is from MarketWatch that's in here, and it's referenced to the ticker that's on the right, each one of these little boxes here. This is just earnings estimates, not available. 3 months ago, we didn't have any analysts. It didn't give me the number, so it just said not available. It showed me 9 for 1 month ago and then 8 for currently. This is in conditional formatting from, if it goes upwards like this currently, if this would be orange, that would be better. But since it's white, it's worse because we've been revised down from negative 93 cents to 3 months ago to negative 98 cents today. And that's the same criteria for all these for fiscal year 2025. These tables right here are just simply from stockanalysis.com. I took that information from there and put them into a spreadsheet. So you can go there and check these numbers. What we're going to do is take the average from 2025 projections. So we're just taking projections here, projection growth rate. We're going to take the average for 3 years, and then we're going to get a growth rate for the 4th year to give us what our revenue will be in 2028. The way I have this set up right now, I'm selected to N16, which is this number here for the final year, the 5th year. We'll be using the same growth rate to project out our revenue for 2029. Now, if we wanted to change that, we would just select O2, which is going to be this percentage, and then select whatever percentage we wanted. I have a spreadsheet in the description of the video. I'm going to put this tab specifically in there so that you can go through and play with these numbers and figure out what you want to do with it. There's no guarantee that this is right or wrong. It's just inputs that create an output. So this is all subjective. It's just a way to try to give the company a future value. So we're going to go ahead and get right into it. We're going to look at the current price of sales for Ionq is 181 times. I have the forward sales and the projected market cap for 2029. Assuming we take an average growth rate here and then grow into 2028, we have 32 million in revenue. If we take that same growth rate and grow out into 2029, that would be 1.2 billion, and that would give us a forward price of sales of 5.61 times. Now remember, this is all just subjective. There's no you got it. Do you believe that they're going to continue to grow this fast? Do you think the numbers are off? Do you think they're going to grow at a slower rate? So you could change all these numbers and use them, tweak them to how you believe. But based on the numbers I just gave you, we will have a forward price of sales of 5.61. That's not an opinion. That's just using the math that I gave you to come up with that number in 2029. If we do the same thing for Rigetti, our current price to sales ratio is 122 times. But right now it's at, if we take the same math that we used up here, apply it down here, it would trade in 2029 for 12.61 times. So it's twice as expensive as Ionq. So you're getting Ionq for a cheaper price based on the projections than you are for Rigetti currently. And then the last one would trade for 165 million. That's a QBTS D-Wave. It would have revenue of 165 million in 2029, not trade. 165 million of revenue in 2029, and it currently trades for 106 times price to sales ratio, which I also did take these prices, current price to sales ratios from stockanalysis.com. The rest is all calculations. Are on forward price to sales of 9.41. So it falls right in kind of between the two of these. Not overvalued, it's right in the middle. The CEO of D-Wave did come on and say that they use a technology called annealing, and the other two companies use gate model quantum computing. Now, D-Wave does do gate model as well, but the annealing has use case today, and they have MasterCard and some other companies. MasterCard was the only company I recognized, the guy mentioned, use it today, and they're supposedly generating revenue from these companies. So just keep that in mind. They have something that is being in use today. Now, with that being said, that sounds like a positive, and I just want to disclose I have a position in D-Wave. That's the only one I have a position in. So keep that in mind. Maybe I'm taking a positive approach when I'm talking about D-Wave because I do have a position in it. Now, I just want to go through a scenario. If we decelerate this from instead of 96% in the final year and made it 50%, so I would just select O2 here because this is O2. Now we'd be trading at 7.37 times, a little more expensive, and it would only be a $949 million market cap. And I'll do that for each one of these. You can see this would be trading at 14 times, and then this one would be trading at 11 times. Now let's assume the opposite, that we go up to 100%. Or maybe let's do 125% revenue growth. Now this would be trading at 4.95 times, or 4.91 times. If we do the same for this one, this would be trading for 9.8 times sales. And if we do the same thing for D-Wave here, this would be trading at 7.52 times. So numbers are subjective. It all depends on what inputs you give it to get an output. It's not cut and dry. It's nothing set in stone. We're just trying to project out the future here. So now that we've done this, what we're going to do is try and project out what if we had earnings in 2029. And today was right now we were in 2029. And then we project out for 10 years using an earnings model, what the price of these three companies are. You need to have positive earnings, which none of these companies do today. That's why we're going to go into 2029 and see what they would have to be trading at for them to be a fair value, assuming we were already in 2029. So I'm only going to go by this earnings model right here that I've got my cursor hovered over, and we have our earnings and our growth rate that we're going to apply here and here, and then we cut that down for the final 5 years in half, and we're using a 15% discount rate and a 15 terminal multiple. So we need positive earnings in order for this to work. So that's why we're rubbing our crystal ball. We're moving into 2029. Today is 2029, and we have 10 cents of earnings for Ionq. That's the ticker we have selected, and we need a 75% growth rate for that to be fair value. Now I'm going to select some different numbers here and see what if we had a lower growth rate but a higher earnings to start in 2029. Now, assuming we started with 20 cents of earnings, we would only need a 60% growth rate for this to be a fair value starting in 2029. And I'm just going to kind of leave it there, and then we'll move on to the next one and then the next one. These are the positive scenarios. If we have we could have negative earnings, and if we have negative earnings, then these stocks are going to probably just tumble. So it's really irrelevant to look at negative earnings. I just want to look at positive earnings and the scenarios with positive earnings. So, if I did this with 10 cents and 50% of revenue growth, these would be overvalued in 2029. And we could do that real quick. Just look at a couple overvalued scenarios. So if we went to 10 cents and even 60% of revenue growth, you can see that this is overvalued. So it's all subjective. We'll do the same thing for Rigetti, and then we'll also do it for D-Wave. So for Rigetti, if we have a 10 cents of earnings and a 75% growth rate and project out to 2039 to get a value in 2040, doing the same thing we did before, we can see this is very undervalued today based on those prices. Now, if we change this to 60%, I'm guessing it's going to still be quite undervalued, like we did with the other one, and it's still undervalued by 100%. If we were to change it down to 50%, it's getting closer to fair value, but still undervalued by about 25%. Now, if we give this 20 cents of earnings like the other one, let's see what growth rate we would even need to be at based on its current price, to be at a fair value. We'll say we'll start with 10%, and that's going to be low. So let's go to 20%. Also not there. And let's start 25%. Still not there. We'll go to 30%. And we're getting close. So about 30% growth rate with 20 cents of earnings would give us, a fair value in 2029. That's what, assuming we were in 2029 right now, and that's using an earnings model. We have no earnings for this. So we're just projecting, we're guessing. This is all guesswork. This is not meant to be taken as, for sure things that are going to happen. It's just because it's not. If we give it a 50% growth rate, we're undervalued by 148%. So 30%, if we go up to 35%, this is undervalued by 17%. So you're looking, assuming that we go from revenue to earnings in 2029. We want to see 20 cents of earnings at a 35% growth rate, between a 30 and 35% growth rate. And that's a fair value for this company, kind of, because we're waiting 5 years. We're tying our money up for 5 years to get there, right? Because it's, about 4 years, 4.5 years to get to that level. So you got to ask yourself if you want to tie your money up. And if there's accelerated massive growth for these companies, then yes. But if not, then maybe not. So it's all up to you. So now we're looking at D-Wave and the current price of D-Wave with 10 cents of earnings, assuming that they can get to 10 cents of earnings at the bottom line in 2029, and then their growth rate is 75% over the next 5 years, cutting that in half 5 years beyond that. And this is the most undervalued of the three, looking at, using that as your math formula. Now, like I said, we're projecting that these are going to have earnings in 2029. I can't reiterate that enough. But so if we change this to 20 cents, if it was to stay at 75%, it would be extremely undervalued, assuming that those growth rates happen. Now, if we, and if you think that these are going to have accelerated growth into the future, now if we cut that down to 50%, we're still undervalued by 284%. Now, if we cut this down to, what were we at, 50%? Let's cut it down to 30%. We are still undervalued by 40%. And if we cut it down to 20%, now we're right around we're overvalued. We have a present value of 481. So for 20 cents, we need about roughly 25% of 25% growth rate to be fair value, going by this model right here. Now, if we cut this down to 10 cents, what kind of growth rate do we need moving forward to be at fair value? Assuming today was 2029. About a 35 to 40% growth rate, it looks like. So yeah, around 35 to 40%. So if we have 10 cents of earnings in 2029 and we grow that annualized by 40%, which sounds like a lot, but these companies are in the early stages. And some of the quantum companies that already have earnings, or companies in the QTUM ETF have earnings that are projected. I think Coherent's earnings are projected for like 600% annualized over the next 5 years or something crazy like that. So it's not out of the realm of possibility that these could grow at a 40% growth rate once they have earnings on the bottom line and they are earnings positive. So it's something to keep in mind. The last thing I'm going to do in this video is just go through some technical analysis for each one, and we're going to determine if they're a buy or not. We'll start with Ionq. So this is a VWAP line of Ionq, and the line here is 2175. So this could fall all the way to 2175 and find support because that's a volume weighted average price line. This is on a daily time frame for 1 year. So you can see we broke out here and we've been in an uptrend, but we just plummeted this past couple, from what? January 6th down to just the last few days. We plummeted down because we were all the way up at $51. Now, I'm just going to use the 63-day exponential moving average to see if we find support or not. And we did find support on the 63-day exponential moving average, and it bounced. And if I can just pull over here, you can see it looks like it's trying to cross the 50 line of the RSI. So that's a bullish indicator. We had this big volume sell-off bar, but then money came back in on Friday. So those are some bullish technicals for Ionq. Now, I'm not a big candlestick guy, but here's some candlesticks that looks like a reversal candle to me, that right here. But I do have a support and resistance. So both of these charts here, the candlestick and the support and resistance chart, are the last 42 days of trading. So there's about 21 days in a month. So I'm using the last 42 days to get support and resistance with for my price action. And you can see the resistance line is 49.17. So you want to see this cross 49.17 if you're a believer that this is going a lot higher. When it breaks that barrier, it should continue to go higher. And this level right here would become support. And that's on a 42-day period. Our support right now is 24.48, and we're trading at 32.33. So if this breaks below 24.48, that could be cause for concern. As I said, we're still 87% above our 30-week moving average. So this has got a lot of downside to its 30-week, but it's curling up. This is an indication of a very bullish stock. And if we were to change this to maybe the 4-week, we can see we're still holding the 4-week. We came slightly under. Once we broke, stocks that hold their 4-week are very, very strong because most stocks do not hold their 4-week moving average. The 10-week, we're separated we're a little below the 10-week. Oh, excuse me, we are below the 4-week because this is Saturday and I haven't got this week's data yet. So we have broke down below the 4-week, and that's because of the big drop. And then the 10-week we're going to be below that by about 6%. I'm doing this on a Saturday evening. I'm using Google. They don't bring in the new week until Sunday morning, like when we're sleeping over Sunday night. If we look at the weekly candlesticks, this is from last week. This does look like a reversal candlestick. So there was some bearish candlestick on the weekly time frame for a downturn, and we got that. So now we're hoping to see something different come into this week. Now, if we look at the trend channel, it's up and to the right. We broke out. We have broke back into the trend channel. So this is the top support. The resistance line here was 35.34, and we broke out above that, but now we're back in it. So we want to see this turn back around and go back above 35.34 to get back above this first resistance level. The second one will be 49 for the support and resistance channel that I showed you. And then our MACD is clearly to the negative, and that's going to be the case for all of them because they broke down a lot this week. However, this is the Chaikin money flow. You can see this came down, hit the zero line, and bounced. It bounced right back up, and right now we're at 5.27, but we came to negative 1.6 on January 8th, and then we turned around. So that's good. That's good news for Ionq. It looks like institutions are saying, okay, enough of the selling. This is a good buying op. This is a good place to buy it. That's not advice. It's just kind of analysis of what I see. Okay, now we're looking at Rigetti, and this is a VWAP line of Rigetti on a 1-year time frame, daily VWAP. And you can see we came down, but we are holding VWAP. That's going to be 805. So you can consider that a support level, 805. If we break below that, that could be cause for concern. So that's a level to watch. we still have 25% of downside to the 30-week moving average, or excuse me, to the 63 exponential moving average on a daily time frame. This is not a weekly one. This is a daily time frame. We did have 3 days of selling, so that's bad. We do have we broke just below the 50, so we want to see this come back above the 50. I like my stocks to be above the 50 when I'm in, when I'm trading for momentum. Couldn't get that out there. When I'm trading for momentum, I want to see these either break across the 50, or once they do and they come back, I want to see them bounce off the 50. This is slightly below the 50, so that's just something to keep in mind. Here's your candlestick chart and then your support and resistance. And for support, we are looking, or for resistance, we're looking at about $19.23. And for support, we're looking at $1.34. So there's a lot of downside to support and very little upside to resistance. So if you're somebody who likes to trade channels or support and resistance, this does have a lot of downside. We're going to look some other parameters to see if if this breaks through this level, which it hasn't yet, but if it does break through and clearly breaks through, this resistance will become its support. This one is very strong against its 30-week moving average, 216% above its 30-week moving average. That is a lot. This is all buyers week after week. We don't have a candle for tomorrow, Sunday yet, January 12th. But we will get one. It's going to be negative because this has come back. But this is a very, very strong bullish stock. However, it is extended. So extended means there's a lot of downside just to touch its 30-week moving average. 216% of downside to touch its 30-week moving average. That's scary, in my opinion. But it doesn't mean that it won't continue to go higher. It's just something to keep in mind. On a weekly time frame, you can see we have all these bullish candles. And now we're looking at the trend channel, and we're up and to the right. We broke out. We've come back down to the bottom of this trend channel. Now this could be a support level, so this could be a key level to look at too. $8.12 is our support, is our resistance level that is now should be acting as support because we broke out so far above it. So that's a key level to me. It's $8.93 right now, the stock, so it's above that. We do have a MACD that broke down, but our Chaikin money flow is showing accumulation. However, the accumulation is starting to weaken slightly. We can see here at the top, we were at about, on January 2nd, 18 of accumulation. Now we're down to 6.5. So if that continues to weaken and go below the zero line, that'd be something to keep an eye on. Okay, the last one we are going to look at is D-Wave, ticker QBTS. This one I do have a position in, so keep that in mind. So when I'm talking about this, I may sound like bullish because I have a bias, right? So I just want to make that clear. This is still above its VWAP. Its VWAP line here on January 10th is 521. Its current price is 577. I think I took a look at this one. The other ones may have as well, but I think even once you got to extended hours, it might have dropped all the way to 528, but that's still slightly above VWAP. So this is a level I'm keeping an eye on, and I may exit this position depending on if it breaks down more or not, or if it bounces. I don't know what the market's going to do this week. I don't know how they're going to act. I have to make a decision. So just keep that in mind. If we look at a daily moving average, we're looking at the 63 exponential moving average. We are still above that by 21% on Friday's close here. We do have selling, three volume bars of selling, but that's after weeks and weeks of our days and days of buying here. We have broke down below the 50 RS line. I'd like to see this turn around and break back above that. That would tell me the institutions are coming back in. And then if we look at the daily candlesticks, you could look at those here, and it's kind of the same as Rigetti for the channel here, or the support and resistance channel. We are up at the top. So if this breaks 991, that would be off to the races even higher. But it could go all the way down to $1.53 for support. So there's a big gap there for support and resistance for people trading this. So if you're a believer in this long term, just know that there could be better days coming for prices. If you believe in it, you might be getting better prices. If you're someone who's trading it, you got to use some disciplined stops. It's up to you. It's your money. You do what you want. So, and then if we look at the weekly moving average, we're well above the weekly moving average, 160%. So this is very extended as well on a weekly time frame. We had bullish buying. We're going to get a bearish bar this week, and it's going to come down some here. But it's still, this number is being calculated by the close price. So we are 160% currently above the 30-week moving average. If we look at the candles, the weekly candlesticks, this is a bearish candle in my opinion, with indecision at a top, and then we're coming back. So we want to see some bullish candles into this week, but I don't think we're going to get that this week. And then if we look at the trend channel, same thing. We are at support here on the trend channel, and $5.30 is the top of the channel. So that is my support level because we broke out of this trend channel, this upper trend, moving up into the right. So this is no longer support. This is support. And if we break through this, the next level of support could be $1.50. So you want to watch right where the price is kind of trading right now. You kind of want to watch that. Same thing, breakdown of the MACD and the Chaikin money flow is tight. And we didn't really get extended like the other ones. This one kind of has just been like hovering. They all were extended back here, but this one's just kind of, not going much of anywhere, but it hasn't broke below the zero line. Yeah, actually, yes, it did. It's just slightly below the zero line. If I hover my mouse over there, it's negative 0.0529. So we want to see this come back across the zero line. That would tell us that institutions are coming back into this money. I'm using multiple indicators to determine if institutions are coming in or out. I don't really intraday trade too much. I look at things on a close and closing basis each day. So that's why I'm able to use Google Sheets for my chart analysis. That's really all I got. I just wanted to give some people some perspective, try to give you some math to try and project out what you would get for price of sales into the future if the revenue was to continue to grow. If that revenue grows and drops to the bottom line and we get earnings, try to project that out for 10 years and bring it back to today with some different scenarios, and then some technical analysis to see if it's breaking down and institutions are 100% out and we should be out, or if there's some hope here. I don't know. I don't have an answer one way or another. It was information so you could decide for yourself. I hope that video was helpful. I hope it gave you something to help you with a decision on these stocks, because I know a lot of people are struggling right now with what to do. If it was, consider hitting the like and subscribe button if you found any value in it. And thank you for watching. That's all I got. Thank you again.